Hello, everyone, and welcome to the NinjaTrader Ecosystem webinar room. Before we get started, I would like to take a moment to test for picture and sound, so if you can hear my voice and see the projection in the room, please type a Y. Thank you, everyone, for confirming that I am coming in loud and clear, and thank you for joining us. My name is Juanita Archuleta, and I work here for NinjaTrader in the Denver office. We have a very special event for you today with Julie Wade of J Auto Trading Strategies. I am going to place a quick poll in the room if I can get everybody to fill that out. And while you fill that out, I would like to mention it is important to understand that there are substantial risks in trading commodity futures contracts and should be carefully considered, you should carefully consider whether such trading is suitable for you and will depend on your specific circumstances and financial resources. It is possible to lose all funds deposited with your broker and could even incur losses beyond these amounts. Please inquire at the following link for a full copy of the CFTC risk disclosure, or if you have any additional questions regarding the disclosure. This presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the trading software. Any brokerage-related questions should be sent directly to our brokerage at the following email address and phone number. Thank you, everyone, for filling out that poll. The question was, what type of tools or services have you used from the NinjaTrader ecosystem? 63% of you have used indicators and strategies. 16% have used our educational services. No one has yet used programming services, and 22% of you are just joining us for the first time today and have not used anything. With new tools added nearly every day, NinjaTrader ecosystem is home to hundreds of apps and services. You can quickly and easily find the tools or services you are looking for with a simple keyword search. You'll also find information about upcoming webinars and an on-demand archive of previously recorded events. Also, if you are active on social media and you would like to receive daily updates regarding NinjaTrader ecosystem, please follow us on Twitter or Facebook using the following links. NinjaTrader is always free for advanced charting, strategy backtesting, and trade simulation. To ensure you are on the latest version of NinjaTrader and to pick up a free live data trial, please use the following link. You can lease or purchase NinjaTrader using the following link. And if you are just getting started with us, we offer free live training on a daily basis. You can view a weekly schedule using the following link. We're very excited for this unique event in which Julie will analyze the NASDAQ 100 futures contract following a late Friday RTH session breakout. Thank you again for your attendance, and without further ado, it is my pleasure to welcome to the NinjaTrader Ecosystem webinar room, Julie. Please go ahead and take it away, Julie. Hey, Julie, it looks like your mic is not unmuted, so you'll need to unmute to be able to go ahead and begin talking.
Alrighty, thank you so much, Juanita. Appreciate that. How's everybody doing? Loud and clear? Is that a yes? Okay, can't tell.
You're coming in good, Julie.
Right, thank you so much, Juanita. Appreciate that. Thanks everybody for attending. I'm Julie, and I've been developing some directional trading strategies for a few years. Been focusing trying to get the volatility component of it worked out, and I'm combining my strategies really with momentum, linear regression, and that higher time frame trend to make the directional trades. The volatility component allows me to get to the first and second targets pretty well, but I have been trying to get a level of confidence to be able to hold trades for that third target or know when to fade a tail or to ride it out. Today we have some good volatility in the market. So I've turned to the option flow to try to find some solutions. And I've learned that I've got a lot more to learn. But I'll cover some basic principles with you today, as well as how I'm using the Bantix QuikStrike option pricing tools to analyze order flow. So you guys relax, stick around. I've got a small special offer for you at the end, and we'll have a short Q&A. Just a quick little background about myself. I do come from a legal background. I did work for a national development company for a little while in the 80s, and they built everything from high-rise office towers, suburban office buildings, shopping centers, apartment complexes throughout the Southeast United States. The Congress back then changed the tax laws and put the developers out of business, so I went back to the law firms. So the majority of my experience is from the corporate law firm. I worked for some very smart attorneys, and they're the ones who taught me how to think. I was active in the paralegal division of the State Bar of Texas, where I served as a CLE chair for a term, and I also served as a treasurer of the local HPA, Houston Paralegal Association. The firms got hit hard by the great financial crisis, as a lot of companies have, and especially during the pandemic, they got double hit. I was laid off and attempted a startup for a while that did not work out, but I learned a lot through that process. Got to do some pitching to some VC funds. I pitched to Venrock, who funded Apple, and I pitched to Mercury. I got mentored by the University of Houston Small Business Administration, and my mentor actually day traded. So we talked a lot more about, the euro and the EU separating from Greece at that time than we did pitch decks and cap tables. But he was trading, and I started day trading back then. So when we didn't get funded for our startup, due a lot to the recession and the fact that there were quite a bit of e-discovery platforms already on the market, I just kept trading and got chased around a bit in the dark pools. Didn't take too long before I lost a good chunk of my capital, and I made the decision to dig in and try to learn what I was doing. So as I've been learning over the years, I've developed my own methodology and indicators using the NinjaTrader platform and Shark Indicators, Bloodhound, and Blackbird add-ons. I could not have accomplished what I've been able to do thus far without those platforms. They're wonderful. I'm now building some proprietary algos and have begun using the QuikStrike analysis tools, which has really plugged in a lot of the answers that I was looking for. So I encourage you to check the chat box. I've put some links for you to download that Bantix, get to the website so that you can register and start using the Bantix software yourself, and also a little booklet that I recommend that can help you understand a little bit about the order flow for the options. It's pretty good. So the usual disclaimer that Juanita just read to you, the most important component of trading is managing risk. The good news is that risk can be measured. The bad news is that future returns are not guaranteed, and the loss of your capital can occur. So please know that past performance is not indicative of future results, and have a coherent plan before deploying your risk capital. Okay, so with that out of the way, let's look back at March 26th, the day of the Archegos Capital Management margin call. If you recall, Archegos was run by that former Tiger Asia manager, Bill Hong. He was forced to unload about 30 billion, I guess. I've heard between 20 and 40, but about 30 billion of shares following that margin call, the inability to meet his margin obligations. But half of those were NASDAQ stocks: Discovery, Viacom, CBS, Baidu, iQIYI, and Farfetch. And since I love that NASI for the ranges, I posted a screenshot of that day of the NQ, and we'll take a look at this a little bit more in depth and talk about some of the pricing sheets that I was able to pull from Bantix to sort of look at maybe what happened underneath the framework here. I'm going to try to get the annotation tool going so that I can get the spotlight going. Here we go. So here you can see in the morning we had a very tight range at the RTH open. The green and blue line are the PT indicator that I use. This is set up for a 1 hour initial balance range. And I like this in the morning because if price is going to go into a trending condition, it'll usually break out of that 1 hour initial balance range. Otherwise, it stays inside the range or flounders around the entire day inside this range. This particular session, we got to the bottom of the 5-minute opening range, bounced back up, and then came very strong momentum and range expansion heading back in to get this Globex low. And this is where the margin call came in. So we've got that big 2 times ATR bull bar sitting here. And so this was a big tell that the Globex was not going to get taken and that the traders were turning this around. So we can see the volume came in, and very late in the session, almost at the close that Friday, we got a second breakout that propelled price even further out of the range towards the pivot points. Very strong momentum above the standard deviation on my Bollinger, and again with the second volume spike. We're going to look again at the Bantix pricing tools in just a moment so that we can see some things under the table that you can't see on the charts. And that's why I recommend that everyone take a look at these option tools, because they really can fill in some holes that we're just not getting on our charts that you will appreciate having. So keep in mind this 12,700 level, 12,800, 700 is where the bottom was, 800 is his middle mean, and the 900 is up here by the pivot point. So 789 are the numbers to remember about this chart. So before we look at the Bantix, let's just talk a little bit very quickly. Most of you are already familiar with this. This is pretty new to me, so it's always good for me to review this. To measure volatility, you can need to do that so that you can make judgments about the risk reward of prospective trades. But there's some easy takeaways about it. Volatility clusters, meaning low volatility periods are going to lead into further low volatility periods, and high vol leads to further high vol. So we can lean that on that to base our directional trades. Most of the time, the market is long and low volatility, except for when you get these big corrections that no one is prepared for. So the second thing that you need to understand is volatility is mean reverting. It can be difficult to find the mean on the VIX, and so that's why I just pulled up a price chart and look at the 50% Fibonacci level of that prior day swing high low. Always have that in the back of my mind, as well as where the current pivot point is, and that's where price will usually trade to on a mean reversion. But it's inside the volatility that changes in delta occur, forcing dealers to re-hedge their exposures, and which causes them to buy and sell the underlying. So I'm learning how to detect these changes in the option pricing and how to position trades around them at some of these key levels. Delta, Gamma, Vega, it's basically delta is the amount of change in the price of an option compared to a corresponding change in the price of the underlying. So what causes delta to change? Gamma is the rate of change in the delta of an option for a unit of change in the underlying price. Delta measures the change in the option premium, whereas gamma measures the momentum. So the gamma measures movement risk. We have a few things that can help us understand when dealer gamma is imbalanced or heavily long. It acts to dampen volatility, and that exasperates with the Fed's QE, making our markets very, very low volatile, yet they float higher, making higher highs despite that low volatility because the dealers or the hedgers are buying into the highs to keep their books delta neutral. So long gamma results in low volatility, and low volatility results in long gamma. It's like a circle. So negative gamma indicates the bigger ranges like we saw today, and lower prices as the market flushes in a correction. Um, these corrections can occur around option cycles, as we're learning. And so that's something to be aware of. I think today threw a little bit of everybody off balance because the Fed was report was yesterday, and everybody's used to being able to rally off of that, and that did not occur today. Vega is an important metric if you're going to be studying options. It's the Greek that measures the sensitivity to implied volatility. So a change in the options price for a 1-point change in implied volatility is your Vega. And it's highest when the underlying price is near the option strike, as Vega will decline as the option approaches expiration. So that Vega is something that's very important that you'll want to study. Volume and futures open interest are two key technical metrics that describe the liquidity or activity of options and futures. Volume refers, of course, to the number of contracts traded in a given period, and open interest, that just refers to the number of contracts that are active or not settled. One thing I'll mention about volume is April, we've had recorded the lowest volume in 6 months, yet we got several new all-time highs during that period. So our fundamentals about volume are really out the window in this era of massive liquidity in the market. Just because you have low volume does not mean that you're not going to get a new high. The VIX is something that you've got to keep your eye on, but it is a little bit misunderstood measure of equity volatility. It's an index, and it measures the expected volatility of the S&P 500 over the next 30 days. The spot prices are calculated daily based on the buying and selling of volatility over the front 2 months of the VIX futures contract. As the index rises, VIX futures can be purchased to hedge against market crashes, but it's lagging. And so sudden spikes, you're not going to already have purchased the VIX futures. So make sure that you always have stops in place for these sudden intraday spikes that can devastate your account. Volatility, again, is mean reverting, but it's a little bit difficult to find the mean on the VIX. Today was, like this perfect trade day for having that volatility spike, and the premium buyers came in and bought that dip and sent it back up. So really a textbook option play for that low volatility period with that unexpected down move flush. And because of the lagging nature of the VIX, I look to volatility through my indicator that measures average volatility. So I get an average realized volatility that's pretty accurate and will allow me to see when price is trading inside the value area or when it's breaking out, and I have an opportunity to trade to the 2 or the 3. So I'm basically trading to 1, 2, and 3 up and down. And that's what I have trying to get very proficient at doing. And just like a bell curve, I'm basing my decisions when the mean reversion price will leave an area and then either go back to the mean or to the other side. And I like going from a coast to coast, from the 3 to the 3 whenever possible. So that is the chart. Here is the bell curve, and this is just a graph depicting a normal distribution, which is the expected distribution of a range. Again, you've got your middle, and you can see the tails are at the end. So these will be heavily defended, and price will often come back towards the mean. And this is what we saw in that Archegos margin call. We'll see that in a little bit, where price was approaching these deviation levels. And I guess if you were a bank and had 30, 40 million dollars, billion dollars of exposure, that you would probably want to push that back in towards the mean yourself. I would. Pete Steidelmeyer in the Chicago Board of Trade in the 60s incorporated the bell curve as part of the profile chart showing the distribution of prices as opposed to a linear timeline. So prices that received the most attention or action in those 30-minute periods were able to get a histogram. So the markets definitely are based around the bell curve. And if you can understand this concept, you can better understand options and trading overall. Here is the first chart for Bantix that I want to show you. It is a weekly intraday volume chart, and you can see the bell curve. And this chart was printed on March 26th, the day of the margin call. And we can see the prices here. There's your 12,700. And your 820 is in the middle of the weekly chart. But we got almost to the end of this strike of the deviation, and that's where they pushed it back in. How I use this is I will look for these strikes hitting the volatility line and look for the volume of that, and I'll use them as targets and try to place my PT lines around these so that I'll have targets to trade to. So I'm doing this a lot differently than option traders, which is kind of interesting because I have a different perspective. But now that I'm learning more about options, I'm starting to realize that I would like to incorporate some premium selling in my strategy as well to complement it. But you can change these metrics. You can change your settings to put any number of days, volatility, or price, and develop your own custom distributions. Or you can change the distributions between your weeklies, monthly, end of month, quarterly up here. And also there are plenty of things to look at. I didn't have a lot of time today, so I didn't print all the screens, but you can get your delta, your call delta, put delta, gamma, Vega, theta bell curves and start reviewing those with the volatility lines. It's a fantastic tool, and I highly, highly recommend that you take a look at it. You can see your implied volatility levels, your standard deviation levels, and your strikes. At the end of the day, I always come back and look at the volume and see where that transpired, in addition to the open interest that are on the charts. This is the monthly chart, and again, you can see the 12.7 and the 8 very clearly where they sent it back up to for that session. Oops. And here's the mean at 970, 12.8 and 9. This is it. Yep. 7, 8, and 9. So I know that a lot of the larger funds and market makers will trade off the monthly chart to place their trades. And I can see why. I mean, it's a great location. I'm aware of where these locations are now, as well as the delta values, and looking for that change in delta, gamma, and Vega, theta, and aware of some other metrics regarding the end of the month, regarding the option expiration schedule, coming in and out of all of these time periods and levels that change that will, require them to re-hedge their positions by the underlying, and that affects directional price movement. So just looking at this from my perspective and finding locations to trade to has been working out really well for me. This next chart is the quarterly, and I don't really look at it that much because it's such a large range. It's not something in my budget that I could ever trade at this time, but definitely look to see where these large ranges are, especially if you get towards the end of the quarter. Make sure that you are aware where these standard deviation levels are so that you can know that to get paid, they want it to be inside that box. Mainly the large funds will use the quarterly as a vehicle for their end of quarter reporting requirements. So I just glance at this to see where the volume strikes are and the standard deviation levels. And I'm again interested in seeing where my PT lines will line up with these strikes and levels. All right, so here is the first pricing, or the pricing sheet that I would like to show you. You can see that this is the monthly contract, and got to move this out of the way. Hang on. And here is the 12,700 for the March 26th. And you can see that we were pushing price all the way back to parity, which is the mean on that bell curve. And here is your delta, gamma, Vega, theta lines. And you can see that the Vega was running back the velocity of it to the mean. So anytime you're running back to your mean with the wind at your back, that can help that sudden shift go quickly in your favor, I think. But definitely look at where these areas change. So when you are moving to a high or a low number, or just changing a number can cause a change, a little bit of a support resistance at some of these areas. Especially if you have a high number, you're not going to want to get outside those lines for theta, which we really didn't talk about yet, but learned that yesterday. That was really good. And just be aware that these statistical levels are very important to monitor on the pricing sheet, so that it doesn't always have to have a strike sitting at the level. The level by itself statistically will cause that price to come back in, as it did on the Archegos margin call. I think that they knew that this was sitting there on, leaving the distribution, and made the change not to allow it to go wild and get outside the area. So I have a suspicion that they knew exactly where price was trading when they made the decision to place those margin calls. Here is something that's very cool. It is an open interest and settlement chart. And this is a great chart to analyze at the end of the trading session. Again, you can go back and see the actual volume traded at the bottom compared to the open interest, and see how that lined up for you for your particular trade session. For that margin call, we were between these levels right here. And you can see the large volume coming in, moving price around. You've got your max pain point for the option traders, telling them where their premium is going to move out of the money. So this is a very good chart to be studying. Again, you can come in and change any of these metrics to customize it for your own purposes. You can get a chart of just the max pain. You can get a chart of the active strikes, open interest. You can show it many different ways. So you can run some reports. It's really a fantastic tool to use. That also shows the total summaries at the end of the highest open interest. And I refer to this one quite often every day. And the heat map is the one that I really pay a lot of time looking at. It shows where positions are being accumulated and allows us to visualize the support resistance as a DOM. We can easily see up and down the price axis where the open interest volume is at each strike. For values where the numbers are positive, the mapping will show white, low to green to high. For values whose numbers can be positive or negative changes, the mapping will range from red low to white middle of the road to green high. The checkered boxes are at the money strikes. And you can see this 700 was the level that they were defending with these puts sitting there. And again, the 800 failed, went to the 7, and then they brought it back. The 800 had a little bit higher put action. But you can use this intraday. I use it as a directional target, like a matador in a bull ring. I'm going to be trading to where these contracts are because you trade to the volume. And that's if you look at a prior open interest or heat map or pricing sheet, you can go back and see at the end of the trade session that price trades in and out of these strikes with the highest volume in them. And then we pushed price back up to the 900 level at the end of the day. So you can put as many contracts on it as you would like. I usually put the weekly and monthly. This does have the quarterly on it also. But I don't put the Mondays and Wednesdays on it. I'll just put like 1 week, maybe 2 at the most, but at the end of the month. If I don't have a 30-day contract, I'd like to get a 30-day, so I'll use the weeklies 1, 2, 3, 4 to do that. But it's very customizable. Again, all of this with the Bantic software, you can create it to show you what you would like to look at. You're probably not looking at it the way I do, but the great thing about support resistance, as you all know, is do not trade to the level by itself. Wait to see how price responds once it gets to the level. Like I'll trade to it. That doesn't mean I'm going to reverse it necessarily. I'll just have to wait and see what happened. Or I'll have a different strategy in mind. And the next slide are the volatility cones. Now this is extremely customizable. Again, you can create these to get whatever value you would like from it. I just like to look at where my standard deviation lines are again, and realize that, when it is mean reverting and you get to a low level, you can expect it to come back in or rise if you're low vol. We keep waiting for it to come back in. Most of the time it doesn't. It just keeps getting lower and lower and lower. But definitely take a look at it and compare it to your prior periods. I've got a 7/14/30 on this. You can extend it back a year. You can look at 3 months, whatever you would like to do, and just get a feel for your ranges and where the volatility is trading and how it clusters. You can also click on these and we'll get price information about how it traded and at what day it traded on. So it's very customizable. I enjoy using these tools. Again, you can customize these to your preference and you know, review these volatility points without being limited to a particular strike or anything that you would want. You can customize it. So here is the quick vol active expirations. And the way I've got this set up is just looking at the implied versus actual. And there's a couple of takeaways that I've been learning about implied volatility. It accounts for expectations of future volatility for the option premiums, while historic volatility measures past trading ranges themselves. Implied vol is not perfect, and it is mean reverting also, but the majority of time it's overstated compared to the historical, and that provides an edge to the option premium sellers. So in low volatility environments, the market melts up, but occasionally will sell off like today, and the VIX spikes up, and that makes the perfect opportunity in terms of volatility selling. So premium selling. So as we saw, they came back in, bought that level today, and it melted back up to the prior close. But historical volatility can help you understand price movements, past price movements, and then you can compare that to the expected price movements of the future via this implied volatility. And whatever your perception for the downside risk is, you can buy options to hedge, or you can just keep your stops in place. But realize where you are on the volatility curve. Is it low? Is it high? Is it medium? What is your expected range going to be? And that's something that's good to have. The volume used to be a good metric that I would pay attention to, but as I was reminded again earlier this week, that when implied volatility is low, the markets are stable, and it takes time and sustained relative volume to turn liquidity dynamics. Like we got that sudden shift today, but usually volume is a good indicator of activity and price directional movement. But due to the low volatility and low the QE, the massive liquidity, that's not so true. April, we had, I think, the first 10 days, the lowest volume recorded in 6 months, and we got a couple of all-time highs. So just because we have low volume doesn't mean that it's not going to rally up and make new all-time highs, because it does. So I look at volume because I'm, used to looking at it, but it doesn't really hold the same meaning during this excessive liquidity that it once did. I think once they start tapering again, and we start seeing that it's okay to go long on long volatility, that we'll start wanting to start paying attention to the volume more than we need to today. In low volatility is just doesn't make a lot of sense to be tracking volume like we used to. And make a full circle back to this 30-minute or this 5-minute candlestick chart. Stocks that the Archegos were holding were, again, those NASDAQ stocks. So anytime you get a big change in some of the major components of your index, it's going to make a big change in the NASDAQ. And as you can see, we've just gotten that big 2 times ATR at the 700 level that propelled price to move up and out of the session on this expansion of range. In the E-mini, which I have a screenshot of, but I didn't include it in this webinar, I can show you a bunch of things. So we're going to have an open house that you can come and look at some live screenshots. You'll see on the 26th that the E-mini actually, when it broke its range, the volatility really escalated over its prior small ranges. But this volatility was sort of, we're going back inside the prior range, and it fell off because it did not expand volatility. We were returning to inside the range. And here is just a screenshot of what the PT indicator looks like, averaging volatility that I show in the Twitter feed a lot. It is a great tool to measure average volatility. I can get daily, I can do monthly, weekly, daily RTH sessions off the open or the close, and they make different distributions. In low volatility environments, I'm used to looking at the smaller distribution sizes because they usually work until you get to a correction like today, and I didn't realize the correction was going to be as large as it was. And once I was able to, adjust my bearings, I opened up the distribution to the later daily size on the close, and it nailed it. I mean, it hit it just like this, right on the nose, and then turned around. So I get a lot of good trade signals from these levels that I use. And again, using volatility like this, you can measure it and use it to measure your risk and your reward. I also find that I can measure the tails with this quite well. And a tail will either go from the mean to the 3 or from the 1 to the 2, and then bring that down on the other side. So I first start from the 1 to the 2. I'll pop that down here and I'll find a tail, usually on the nose that way. Or if it breaks that, I can take the distribution from the mean to the 3 and usually capture a good location to send it back into the value area. In an environment that we're trading where everything is pretty much set up to go long, the best place, of course, to enter is on these lows when the momentum is red and everything is sell, sell, sell. And here, if you've got some good levels to trade, it can be quite profitable to manage your risk by throwing a managed risk trade at the tail, sending it back in. Again, I do this with other directional tools that I've got momentum. I'll wait for a momentum signal, usually with a bar close. But once you get that confirmation, that's a great location to get some of those 3 to 3s that I was talking about, those coast to coasts. And here is a screenshot of what it looks like to overlay the pricing tools that I'm getting off of those bell curves, the strikes, and the standard deviation levels. And I overlay that onto the JATS chart. I'm working on updating the PT3 indicator to get these automatically drawn on the chart for the highest strikes and those deviation levels from the weekly and monthly to automatically appear on the chart. So that'll be very good. And maybe some other things too with the options data. But for now, I'm just hand drawing them on the chart and find that they complement very well, especially when I can get a confluence at a level, I'll have that much more confidence in it to use this as that out of bound trade. Because as you remember, volatility is mean reverting. When you get to the end of your range, it usually comes back. or that's what the equity indexes are especially designed to do. And they work out pretty well doing that. So that's about it. This is a great ebook, the Implied Volatility Order Book. And I highly recommend that you download that. Again, I popped that into the box, and we will be that much ahead of the game by reviewing, the stuff that today was pretty much educational. But just figuring out that there's a lot more to directional trading than just having a strategy for a MACD or an RSI or whatever we've previously been trained to do, to use all of the tools that are available to us and put things together and realize that there is a definite system for order flow that's directed by these option trades. And once we can be aware of that, then we can put that into our trade plans. I'd like to see those gamma flips. I'd like to see those Vega flips. I'd like to see quite a few things. So send me an email, and I will send you a link for the open house. We'll look at some live screens and live charts tomorrow and next week. Come and go as you please. Usually do it from 8:30 to 10 or 10:30, depending upon price action. And you can check everything out. I'm also going to have a small sale going on. So if you like any of the indicators that are on the website, let me know and I'll send you a discount before you purchase it. And my contact information is here, support at J Auto Trading Strategies. And be sure to check out my Twitter or my Facebook page. And before we end, I'd like to say a special thank you to Shark Indicators and Ninja Trader. Again, I could not have gotten to the point where I'm at without them. I'd also like to give a special shout out to Adrian and Zach and Jeremy, Keith, Nick, Sasha, and Jam. And for my new learning and all of the Ninja Trader support staff. I've got to just mention the support staff over there is phenomenal. They have gone above and beyond for me a couple of times. I really appreciate it, as well as my customers. I thank you so much. I have a lot of long-time customers, and it's a low pressure. I'm not emailing you. I don't send emails out all the time, so pretty low key. And so with that, I don't know if I have time to try to minimize this to, I don't know if you can see the QuikStrike screen behind it. Can you see that, Juanita?
Yes, it's coming through.
Okay, so I wasn't sure if that was going to work or not. Here's the current QuikStrike for today. We can look at, this is the E-mini NQ. And you can see I've got this on a weekly, the QN1K1. And this is the first one that I will look at the way I use the distributions. And you can see the strikes hit the volatility lines. And you can look at the delta. Oops, what happened here? There it is. So you can, for instance, if you want to look for call delta or put delta, you can change it to look at your skews. There's your put delta. I think I've got this annotation thing going on here. Spotlight. There's a put delta. And I'll, really focus in on where these volatility levels cross are red lines in the middle, and especially if it gets to a standard deviation level. And here is the gamma one. See if I can get that to come up. I think there's a little bit of a delay with the streaming, having some trouble getting these to click. I've got this spotlight going. So I'm having a little bit of trouble getting it to click, but definitely check out these tools. They're fantastic. There it goes, a little bit of a delayed reaction. See if I can pull up the pricing sheet really quick. There we go. The pricing sheet's fantastic. You've got 6 or 8 models that you can use. I use the Black-Scholes. I'll change it to the settlement and click OK. And this will show you where that parity is and where price currently is. And you can see your theta, vega, gamma, delta here and see where you are. You can see we're at the end of the contract. We're in the zeros for the Vega. And see how price responds to these levels. Again, trying to see if anything popped out. You can change your to the end of the month. These are so fantastic that you can, if you want to see a 30-day distribution, you can just type in the number of days, change it, and it will give you a new curve. Now I want to put it on the settlement, change that back. And you can get your values for 30 days out. Oh, I didn't change it. There it is. There we go. So there you see you've got your different levels for 30 days out. So it's very customizable. You can just spend hours looking at this and studying it and trying to get your. I think it's a great tools. There's just so much to go through. Like I said, we'll spend a little bit more time with it in the trade room tomorrow. So let's take a look at some questions here. I'm out of time. Scroll back up. Thanks, guys. I appreciate your telling me that y'all could hear me this morning. Someone is asking about gamma and short gamma. Well, gamma is the change of delta. So when it's the momentum of delta changing. So watch those levels. Let's put back a pricing sheet. So here is your gamma levels, and you can see that they are in, I've got your 30 days. Let me just put this on a normal end of month.
Hi, Julie.
Uh-huh.
I just wanted to let you know we're going to have to be closing out here in just a few minutes, okay?
Sure, sure, sure. So you can follow your levels right here, and you can see the change in momentum, and realize that that is going to be the momentum for the delta change. So gamma is the momentum of the delta change. Is futures open interest available intraday? Yes, I mean, you can get these levels intraday. Yes, on this CME tool, you can. Are options on futures that reliable? Volume and open interest is smaller. That's a good question, Miguel. When you look at options, you see that they're so small compared to the um, contract, the futures contract. And I thought the same thing. You put this on the equities, and you can see that I had a chart up. You can see at the very top, the little blue line at the top represents options, and the big blue bar represents the futures. But that little tiny blue top thing greatly affects the futures price. I thought exactly the same thing that you were thinking. How could it possibly affect it? But it does, because that little tiny top are the people who control the markets. So you've got to watch them like a hawk. This CME is just CME Group.com. And once you go to the CME Group, you can look at their data tab and then look at volume and open interest. And then you can go to any of your, and then scroll down and you can get the overall volume for the exchange or for your futures contract or your options contract. And again, just be very careful when looking at volume, because like I said, we had the lowest volume recorded in the last 6 months, yet we got brand new highs in the market. Thank you so much. Appreciate that, Ari. And my email address, support@jautotradingstrategies. And do send me an email for the open house. We'll have plenty of more time tomorrow and next week to look at everything. And thank you so much, Juanita, for allowing me to have this session today. I appreciate it. And I'll look forward to seeing everyone tomorrow or next week.
Thank you so much, Julie. I'd like to give a special thank you to J Auto Trading Strategies for a great presentation. Everyone in attendance here today will receive an on-demand recording of today's event. Please keep an eye out for that email. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value added for our clients. If you find value in these events, we do them on a regular basis. We'd like to remind you that the information provided in this is that of J Auto Trading Strategies and not of NinjaTraders. All information is for educational purposes and should not be construed as trading advice. Again, we do appreciate the time you spend with us. We hope you enjoy the rest of your day and happy trading from all of us here at NinjaTrader. Thank you again, Julie, and have a wonderful afternoon.
Okay. Thank you, ma'am. Bye-bye.